Okay, why don't we go ahead and get started? We've got about 30 people on. We had about 130 people sign up, and we usually get about 50% participation from signups. So we're getting there. Yeah. So let's go ahead and get started, guys. So welcome to our webinar today. My name is Brad Ulig. My business partner Jay Peterson's with me here, and then we have CPA Dan Marsh joining us to talk about proposed tax law changes and how to minimize the impact on your real estate investments. Again, hang on a second. Why am I struggling? Again, my name is Brad Ulig, Jay Peterson. We also have an associate broker, Charlie Middlehouse, with us these days, so you may get phone calls, et cetera, from time to time from Charlie. Yeah. So be aware of that. This is all of our contact information if you need to get a hold of us. And just a little bit of background on who we are and what we do. We talk about this every webinar, but for those of you who haven't been on a webinar with us, we are real estate brokers. We specialize in essentially small investment properties, anything from a condo up to a 12-unit apartment building. Our sweet spot is really 2 to 8 units, so duplexes up to 8 units. And we've been doing this for quite a while, since 2009. We've got a database of over 5,000 investors here in town. We have a lot of connections with regard to contractors and things like that to help investors with anything they need to do with regard to finding a property, fixing it, analyzing it, financing it, all that good stuff. We also invest in properties ourselves from time to time. So we've got a lot of knowledge here that we're happy to pass on to any investor that's interested in talking to us. We don't do property management per se ourselves, but we do work with 2 very experienced property management partners. And so if you're looking for property management, feel free to reach out to us, and we're happy to put you in touch with the right person. Currently, we've been in a little bit of a growth mode at Westpeak Properties, so we're looking for other brokers who might want to join us. Specifically, if you are in or know of somebody in the Colorado Springs market, we're looking for somebody to help us there. We get a lot of leads down there, but we don't have feet on the street down there, so we'd be super interested if anybody's down there that wants to join our brokerage team. We do these webinars from time to time. We host educational webinars throughout the year. We have future webinars planned on estate planning and cost segregation. In fact, I think our next one we'll probably do is on cost segregation. We do have past webinars that you can check out on our education tab of our website. That's westpeakproperties.com. We've got webinars up there on Section 8 rentals, Airbnb practices, best practices for property management, 1031 exchanges. We'll put this one up after as well. And just so everybody knows, we will send the recording of this one out to everybody that registered once we're done with this. And that usually goes out the day after. So look for that tomorrow. So for today, we've got Dan Marsh CPA. He's going to be discussing these tax law changes and how to minimize their effect. Dan comes to us through a relationship with the Apartment Association of Metro Denver. He has years of experience, and I'll let him explain, all of his credentials. But essentially, he works a lot with investors that own real estate, and he's been a trusted partner of ours for a couple of years now. So he's going to talk for about 30 minutes, and we will take questions along the way. So if you have questions, just go ahead and type those in. Jay will monitor the Q&A for us and let Dan know what questions we have. And so, Dan, why don't you go ahead and take it from here, and we'll let you get started.
Okay, let's see if I can jump it over. Share my screen. I'll do that. Just give me a second to share the screen, right?
There you go. You just got to put your slideshow on. You're good.
There you go. Okay, well, thanks for coming, everybody, to look at this. I really appreciate it, and I've tried to summarize a couple of things here. Obviously, I'm a CPA here in the Denver Metro, and one of the things that probably prompted this, I'm getting tons of phone calls on it. People are getting a little bit nervous about what may be coming through Congress. So we thought of putting something together just kind of just telling people what's coming down the pipe. And obviously a lot of this is proposed, but some of this will actually go into law, and we just don't know what, and we don't know how it'll work itself out, but it's good to kind of know what they're thinking about in Washington, and give you some insight on maybe some things you can do. So I'm going to jump right into it and kind of, I really summarize it down into really three things of what's been talked about in Washington, and the things that are going to affect real estate, I think, the most, right? As you can see, I put them in three categories. There's talk or discussion of getting rid of the 1031 exchange. There's also been some talk of changing, and this is probably the one I get the most calls on, long-term capital gains tax rates. We'll go through that a little bit and kind of look at that, because I think that's what most people are really nervous about. But the third one is the one that makes me the most nervous, because it has the biggest impact, and that's the estate taxes. So these are the big three, I think, that we're starting to hear a lot of stuff on in Washington. We're getting a lot of buzz on this, and we're getting people, a lot of phone calls on it, because people are reading it in their trade magazines and their different publications. So let's dive in and go right into the 1031. And most people already know what a 1031 is. It's called a like-kind exchange. And really what it's for is currently you can take your property, and you can, if you do things correctly, you can exchange tax deferred, right, for another property. In essence, I can take my current property I've held for however long you've held it, turn around and then simply purchase another property and exchange it. There's a bunch of rules that go with that, and I won't go into those. But that's been the standard for almost 100 years is the 1031 or like-kind exchange. One of the things that's been talked about a lot in Washington is they want to eliminate that or curtail it. And you know that it's coming out because you keep hearing the word loophole, right? We keep hearing out of Washington that 1031s are a loophole. I disagree it's a loophole because it's just been around so long, and there's actually a code section, 1031, that has it there. But their current proposal, this is the current administration, it isn't that they want to eliminate it. Their thought is to reduce it down to $500,000 or $1 million filing joint. And, take it for what it's worth. Currently what we have is something that is there's no limits to it. You can do as much as you want, to cutting it down to limiting how much you can exchange that's tax deferred or tax free. Where this is going to fall out, we don't know, because obviously it's just a proposal. And this was talked about obviously in the last legislative session as well, was can we eliminate the 1031 or curtail it? And I don't know, we don't know if that's going to come about, but it's definitely being talked about, and it's getting more serious. Some of the solutions, if they do pass this law, I tried to think of things that what you can do, and without really defining or seeing what they have as a final law, what we're going to try to do is think of some things that we can do in order to kind of dodge it or offset it, right? Solutions we can do is kind of get prepared, right? Is to look at your portfolio and really decide if you're going to keep stuff long term. If it's something you're getting ready to move, exchange in the next year or two, it may be a time to get out and sell it if you're thinking about dumping it. Or the other thing that I've listed out here is can you potentially shrink the size of the like-kind exchange you're doing? And how do you do that? Can you do a partial exchange? Limit the number of exchanges that you do in a year. Rather than you do 6 of them or 8 of them, you simply do 1 a year in order to get below that threshold, right? That's what we're seeing, but we don't know what they mean when they say they're eliminating the threshold. Does that mean it's a dollar value, number of properties, both? We'll have to see more finalization of the law before we know exactly what to do. But these are just some things that I think that we're going to be able to do that may work. One of the strategies I already use a lot is whenever we get sales, I like to talk about people or clients, if they're trying to eliminate some of the gain that may have occurred, is potentially simply to use a cost segregation study, right? In essence, to offset my gain with some of the law. Hopefully that makes a little bit of sense. When you have a big gain, is to use some strategy to offset some of that gain on your tax return if you can't use or have hit some kind of threshold on that 1031, okay?
Hey, Dan, there's a quick question here. Is the 500,000 referencing 500,000 of gain or what?
500,000 of income.
I think it's income. Yeah, it would be the income from the sale, or not on the deferred piece, but it's the actual amount of deferred gain. Excuse me. They're going to try to limit, right? 500 single or 1 million married filing jointly. Does that make sense? In essence, they're only going to limit. They're going to limit the amount of deferred gain.
If you did an exchange and you had $1 million of gain, $500,000 of that would be deferred.
Yes,
would still be allowed to be deferred, and $500,000 of it you'd pay taxes on.
Allegedly, yeah, that's what we think is
Okay.
going to allow a portion thereof, right, or limit the amount that you can defer.
Okay.
The big theme that I think we're seeing with this legislative session in Washington is really you're looking for ways to force long-term capital gain into taxable into the tax bucket. In essence, they're trying to eliminate your ability to manipulate it. Right? Is simply skip or don't sell the property for X number of years and simply just skip over some big tax consequence. And we'll go through that a little bit. But that's really the theme, I think, of what they're after and what they're trying to go after. So any other questions? I'll dive over to the next one. We can ask those later too on like exchanges about what's coming.
Not at the moment.
Okay. So that's just be aware of it. I would definitely be aware that this may get limited. And if that's been your strategy for a long time, is that you simply roll over properties, that might go away. And I can't tell you if it will or not, but it's getting talked about and it's getting more serious. So there may be some limitation on the 1031.
My thought is that maybe it won't go away just because there's a lot of people on both sides of the fence in Congress that own property.
That's the beauty of real estate is no matter what party you're in, there seems to be a lot of people that own real estate, and everybody wants to tax someone else, but when they come to taxing themselves, I don't know if they want that as bad as they really want. Well, here's really the second big piece that I think is getting proposed, and obviously I get tons of phone calls on this. And you can see at the bottom, I put it on there. The reason we're getting a lot of phone calls on it is Biden has actually come out and said he'd like to do it retroactively. And people keep calling me, asking me, can they do that? Are they allowed to do it? And they can. It's just not been done very often, right? Especially for a tax increase. Mostly that's decreases. But retroactive increases are possible. And this one is kind of nasty. It's almost a doubling of long-term capital gains rate. You're going to go through that. But I think it would be patently unfair to do that. He wants to do it back to April of this year. But I don't think that would be fair to most people. So the current legislation, obviously, most people are aware of this. I've kind of built that bracket where, the highest gain rate you can get, or marginal gain rate, is 20%, right, for federal tax purposes. If you include the extra 3.8% if you're subject to it, that's 23.8% federal, plus if you live in California, state, or New York, whatever, Minnesota or Colorado, you've got some state taxes as well. That's worked for, when this came in was, I think, George Bush brought these taxes in, these graduated rates for cap gains. And so far, it's been pretty good. And their big thing now is they'd like to change it. And obviously, you can see kind of what their theme is. I put those brackets in, but those will definitely change at some point if they do pass this kind of legislation. That's the best we can do as far as what we know is leave the current two brackets. Excuse me. And then they want to bump that anything above $1 million, right, in cap gains, over 39.6%. So that would be ordinary income rate. Right? That's going to be a doubling, virtually a doubling of your capital gains rates if you sell something. So who's that's going to snare if you're going to sell a big property? And again, we don't know what that means either. Is $1 million for property? Is it $1 million for your portion thereof of a property? I.e., can you do things like contribute it to a partnership and simply split the property gain, with somebody else? We don't know yet. They're talking about making it per person, but obviously the way the IRS works, they'll build in anti-abuse provisions on that, so you can't simply do things like separate properties or split it with your wife or your cousin, things like that. So what does that really mean? I built an example for most people. if you got a $1.1 million property, 200 of which is capital gain, you're going to end up with about 100,000 of that gain subject to that new rate, 39.6% rate. That's the that's what we're a little worried about is what do you do if you're going to get snared in this? And that's not only for properties, but people who sell businesses, own farms, selling land, all kinds of stuff is going to get pulled into this, and it makes it particularly nasty. And obviously on the bottom, the thing that makes it even more nasty is we don't know yet if he's going to make it retroactive or they're going to try to make it retroactive. Honestly, they had testimony, I think, from 6 different banks on the Capitol Hill. They said that it would be a terrible idea simply because it snares people who weren't ready for this law to snap in, and it would double what they're going to pay in tax. So it makes it really economically difficult to do that because people have obviously done things like spent the money and not been able to pay the tax. So what are the solutions you can do? Again, it's the same thing. If this comes up, is get prepared, right? Is you need to look at what you've got if you're thinking about selling something, and try to find out if there's a way you can dodge it or get below that $1 million threshold, or if it is a little bit above, but work on trying to figure out where am I at in my portfolio of real estate. Is it something I'm going to eliminate here in the next couple of years? Maybe I can accelerate it and do it a little bit earlier rather than doubling the amount of tax that you have to pay. And the other thing too is really look at your portfolio and say, hey, these are the properties I'm going to hold on to for long term, right? I'm going to hold them for the next 8 years or the next at least 4.5 until another administration or some other laws get passed to really reduce it. But the other thing that we always...
So let me interject. So if you're saying, from a planning perspective, if you've got something that you want to sell in the next year or two, you might want to think about selling it now versus waiting 2 years, because once you're in 2 years, you may be at a new rate, and then you have to hold it until hopefully at some point in the future rates come down.
Exactly. That's exactly it.
Okay.
Again, we don't know if rates will go up, but what we do see is if you go around a room and say, where do you think taxes are? Are they historically low or historically high? They're historically low. So the federal government is looking, and your legislatures are looking for ways to increase taxes in certain spots, right? And so that's, it's concerning. We're trying to figure out what to do with it. My scare is obviously the retroactive tax, but it's really trying to get people prepared that if taxes do go up, is there ways we can dodge it or get around this? We don't know yet, exactly what those anti-abuse provisions, shifting of gains from multiple years, using installment sales. We haven't seen that yet, but those are some of the likely things that we're going to have to think about is a little bit heavier tax planning of how do we get around some of these gains. Can we, if we postpone or delay it, sell portions of it? Can we get together and marry, or what they call tax loss harvesting, right? Is looking to marry up gains with losses. Great loss item is obviously and it becomes more worthwhile is like cost segregation, because we're talking about bigger gains or enough cost segregation to get us drop below that threshold of $1 million. The other thing that I got in here is utilizing a like-kind exchange. Problem is, or if they limit it to $1 million, it traps us in this funny thing that we can't do a like-kind exchange either. But that's really where we're at on those long-term capital gains. And I think most people are just, like I said, worried about really that can they really double this tax? And they've done it twice since I've been a CPA, but that's both for tax cuts. I don't remember anything in the last 20, 25 years where they've increased taxes retroactively, but that doesn't mean they can't and punch it back to April. And if they do that, I still think it's a horrendous idea. Most economists agree, and most of the banks are agreeing it's a terrible idea if they do it. But sometimes legislators listen, sometimes they don't. So we just have to change the way we behave, I guess. Anyway,
Dan. There's a question here: would installment sales be a good way to spread out gains? and or seller carried loans to buyers?
So installment sales might be, we just don't know. My guess would be, here's my guesstimate, right? In essence, I'll bet you when they write this law, they will include in the law that says, hey, if it's more than $1 million sale or if it's more than $1 million gain, the rate, they're going to lock that rate in, i.e., I don't think they're going to allow you simply to use an installment sale to dodge the gain or a seller carryback, right? It's in essence pay for it over time. And I don't know, but that would be my guesstimate because everybody will do it, right? Everybody will jump into that's what I'm talking about, those abuse provisions. It's trying to shift that gain to another year if you can. I'm guessing there will be some, but yeah, seller carry, I will, if this goes through, my guesstimate would be they will prevent that from occurring, meaning they'll force that tax into a higher rate. You won't be able to dodge around it by merely making an installment sale or a seller carried note, unfortunately.
Well, I mean, the seller carry note, if you're carrying the note, they're only paying a certain portion of the principal at any given year, right? So, right. And that's the only portion that you're taxed on from a gains perspective. Because that's the only part of the gain that you recognize. So I don't see how they could tax you on the whole thing if you don't even have the money to pay the tax.
No, they'll tax you, but they will tax it based on whatever that gain was going to be, right? In essence, what is it? Recapture is non-installment, but gain is. In essence, they'll say, hey, the overall gains, $2 million, therefore 1 million of it will, you collect 200,000 of a year, they'll split it 50-50, right? 100,000 being at a lower rate, 100,000 at a higher rate each year. That will be my guesstimate of what they'll do is to prevent that shifting or moving of gain from one year to the next. I'm not certain of that, but that would be my guess. The other.
So you're saying the portion of it that you recognize as gain, they would tax at the higher rate?
Yes. Yep. And I think they do that just to prevent people from doing it, because obviously that's the quickest thing people could do is just simply do an installment sale and get around it.
Still though, if that portion is a lower number, you're deferring your tax. Yes. And hoping that over the course of that seller carryback, things change.
Possibly, yeah.
For the better, right?
Yeah. I mean, if my guess would be it's locked in once you do it, right? If you're doing on installment, the IRS will lock that in at a higher rate. That would be my guesstimate. I just don't know for certain until we see a little bit more. But if they do pass it, right? There's a bunch more work they got to do in Congress in order to get both sides on the table, or get rid of the filibuster and stuff it down. But I don't know. It'll get negotiated out, right? We'll see some kind of negotiated settlement on all these items. They'll get some of them, they won't get others. The one I think we're going to get though is this next one. This is the one that kind of sounds like they're going to cave on it or going to allow it to go through, and that's a state tax, right? This is my biggest worry is this one. It's the like-kind exchange is somewhat. I've seen that one before. Like-kind exchanges they don't like, they want to get rid of, but they kind of keep going. It's a lot of people in real estate, even on both sides of the fence, Democrat, Republican, and then also the cap gains has been talked about before. But this one, Trump kicked it up to $11.7 million exemption, right? That's still in effect for 2021. Put a little meaning of what that means is, in essence, $11.7 million exemption equals I have an $11.8 million estate. My 11.7 is exempt. The 100,000 I pay a state tax on. You always get, and it has for the last 100 years, what's called a free step up in basis. Great example is I have a $100,000 property. I bought it for $1. I dropped dead. I bought it in 1950. I dropped dead, pass it to my heirs, and it's worth $1 million. My basis to my heir now is $1 million. In essence, it passes through the estate. You get a free step up in basis I've got that example right below it. If they turn around and sell it the next day, they have no gain or loss. And that's kind of been the established thing. It's what, if you ever look at family farms, this is what they've relied on for decades, for almost 100 years actually. How they can pass it to their heirs without having to pay lots of tax on that land is simply they get this free step up in basis, and every time someone passes away or dies, the basis re-steps up, and they move on down the road. No tax, no harm, no foul, and that's it. There's another codicil to this. It's really the gift tax, and gift tax are linked to estate tax. In essence, what that means is if you currently give away money to your kids, you can give $15,000 away to a donor, maybe a donee. So you and your wife can give away $15,000 each to each kid in your family if you want to. In essence, without having to fill out a gift tax, without dipping into what I call a lifetime exemption, like $11 million worth of that exemption. If you give more than $15,000 per donee away, it dips into the 11.7 million. It reduces the amount of estate that you pay eventually when you pass away. That's been the way it's done for almost 100 years. I think it's been effective. I'll give you what they're going to propose to change, and it's a little terrifying, but this is what we're currently talking about now. I've talked to a bunch of attorneys where they think, the estate guys, about where they think it's going to be, and they think it's going to be 3.5 million to 5, right? So think about real estate investors. How hard is it to get to 3.5 million in Denver anymore? You know, that's what, 6 houses, 3 houses. It isn't a lot. So you're in the estate tax problem really quickly. The other piece that's proposed, it's really a second layer of tax. It's this getting rid of the ability to defer gains. And here's what I mean. They're talking about getting rid of that free step up in basis. In essence, when you pass away, the IRS, or excuse me, I don't say the IRS, Congress would like to pass it where on the date of death, we'll give you a $1 million exemption on everything, but on that date, everything is as if you sold it. So you get a $1 million exemption. That doesn't include your home, but that would be, everything would then simply be say, hey, we give you $1 million exemption. It's as if you sold everything on that date. And then that's your capital gains. And oh, by the way, once you're done with that, now we're going to take it and you go into estate tax. So if you got anything left after that first layer, then you jump over into the estate tax layer at 3.5 to 5 million and do it again. So they're in essence trying to get rid of the basis, the free basis step up. So this means family farmers, small business owners, real estate owners, that everything above $1 million in your state is simply going to be stepped up, and then the step up is going to be taxable. And if you think about real estate, right? How liquid is it when they do that? You know, the IRS doesn't like waiting around for the money. You got on estate tax, it's 9 months, right? The gains probably, you got 9 months to come up with the cash. And that's really how it works in estate tax. It's devastating, especially in a down market. So here's my solutions, and these are the same old solutions that I've always worked for estate tax. Use up that annual exclusion, right? If they do drop this 11.7 down to, let's say, 3.5 million or 5, that means if I give it away this year, eat into that 11.7 million, and they do drop it, it goes away anyway, meaning there's no harm nor foul. It doesn't offset my new 5.7 million. It offsets the old 11.7. If it vanishes, it just vanishes. It's gone forever if you don't use it up or dip into it. So what do you have clients doing right now? And biggest, they're giving money away to their decedents or to their beneficiaries simply because their expectation is that the estate tax is going to drop. So if you can do that, definitely talk to your estate planner or your estate planning attorney and really go through that, because I think it's a good idea, right? If you can get stuff out of your estate now rather than go through that proposed reg if it does come to fruition. So you can see, Mike, get an estate plan put together, right? Don't. I've seen it enough times in my career. Somebody comes in, they pass away, no estate plan. We're liquidating real estate. And we're sometimes doing it fire sale prices in order to pay off the IRS. Isn't the funnest way to go, and it really will liquidate people's wealth. If a lot of people have spent lifetimes building this wealth, and it's just going to evaporate in 9 months. So. The other thing, look at your liquidity, right? If you're looking at having to do this at some point, or you've got a relative with this kind of thing, going on. Liquidity in real estate is key to estate taxes. If you have got no cash, your only choice is really to sell off that real estate in order to pay the tax. So if you don't want that to occur, there's things you can do, and there's a lot of things you can do. So I would definitely be conscious of it, be aware of it, because it's nasty. This double tax for a state is super nasty, and if it comes to fruition, it's kind of changed the like I was talking about earlier with Jay and Brad, is, you know, really, if you think about what we're doing in tax, the game is still the same. The referees on the field have changed. So we're going to change how we play the game a little bit. And we've got to be more prepared than we used to be, because we don't have the big, huge exemptions. We don't have, we've got more rules that we're going to have to jump through some hoops. But if we plan it right, we can still minimize some of these problems just with a little bit of planning. Hopefully that makes sense. Questions?
So I have a question for you, Dan, since I'm confused. So when you say this double tax, can you run that through me again? Because let's say we've got a $3.5 million exemption, and I had an estate that was worth $5 million. So I'm going to have to pay estate taxes on $1.5 million, right?
Well, if they get what they propose, they've got two layers of it. So if you came in and said, "Hey, I've got your first step is not skipping the first piece. I drop dead, right? Or Brad drops dead."
Not skip that part. No, I didn't. We can skip that part.
Somebody dies, right? And
Somebody dies.
what happens is they first and foremost say, "Well, we're going to treat it as if you sold everything the day you died." That isn't even in the estate tax. In essence, we treat it as, let's say your basis, and it's
sure. So let's say based on my basis versus my value, we sold that, it was worth $5 million.
Yep. So your $5 million, and you had $1 million basis, you've got a $1 million exemption first on that. And then anything after that is capital gain. So it'd be a $3 million capital gain. And
well, wait a minute. I thought I had a $3.5 million exemption.
Well, but the first thing before you get to estate tax is you've got to get through that basis step up piece.
Yeah. Okay.
Piece. That's that extra layer of tax they're talking about. So what they're going to do is say, okay, it's worth $5 million. You got $1 million basis. We're going to give you $1 million exemption. And then everything after that is taxable. So you go from $5 million fair market value, reduce it down to, but I don't know if it's $1 million gain exemption or if it's $1 million exemption on the asset. Let's hypothetically say it's the asset. It drops to $4 million. My gain is 3 minus 4 is equal to $1 million gain, which is calculated, I believe, just how those ordinary gains are calculated. So that would mean it would run through, those higher, if there's a higher bracket, it would run through and pay ordinary taxes. Now you've got your basis stepped up, right? Now it goes through estate taxes. So if you've got any money left, we now jump into estate tax to see how that shakes out. Does that make sense? In essence, that $3.5 million exemption is still there, but you've already had it shrank down by the gain that you've just paid on the date of death. That's that new. They're not going to give you a free step up in basis, is what they're saying. They're basically saying your basis has to be, in essence, the basis to fair market value, that step has to be paid for with taxes. And once that's done, then you pay the estate tax. So it's 2 layers of tax on dying. So the thing you want to do is live forever.
Yeah, don't die, right?
Right? Or just transfer everything to your surrogate, who is, maybe it's maybe if we can, I never thought of this. Maybe just keep getting married, or passing it through to your next husband, wife. Just keep marrying somebody so it passes through that exemption, and never. But it gets hard to pass it on to the next. But that's the reality of it. It's really a 2-step process. I don't know if they'll get through with the 2-step process. They might. The odds are they'll get at least some kind of reduction in the value in the estate tax exemption, but I don't know if they'll get this other reg passed of of trying to say you don't get a free step up in basis anymore. You have to tax your way to the new basis, and then you go through estate taxes. So it's a really nasty tax. It puts us into the highest taxes in the free world for death and estate. So that's, it's a little tricky. If you've got a real taxable estate, there's real issues with this that just aren't going to go away by themselves. So, and like I said, think about your real estate portfolio. If what's it take to get to 3.5 to 5 million worth anymore in Denver or in surrounding areas? I mean, an average price of a home, 650, 700. Single family homes. If we get into apartments, we're going to be in estate tax problem. So, think about it that way. It's an onerous layer of tax that they've added, and the amount of exemptions dropping. So, the government will get your money. If you do nothing, they will definitely get it. So that's
Jay, someone's asking here, Dan, if you can still use irrevocable trust as a way to shift assets out of your estate.
Yes. Yeah. So you could still use all the old tactics still appear to be working, right? It's for most people, 90% of the people that I come in meet don't have anything. They have no estate plan. They've got no irrevocable trust or revocable to irrevocable trust or grantor trust. They've really set nothing up, and because nobody wants to talk about your own death. And so a lot of people come in and say, I have nothing. And we spend a lot of time really talking about getting ready, getting something set up. Don't just hope that you'll live forever or that you'll do it tomorrow. It is, if it gets done tomorrow, it may not be the way you expect. So
right. Well, not only that, but if you had a plan,
yeah,
you need to go back in and reassess that plan, right? You need to.
Yeah. Because everything we've had is, if at 11.7 million, it was, we had a pretty big limit, right? I mean, that didn't dive into what I call middle and upper middle class people. It was kind of a good sized limit that you didn't have to worry too much about estate. It got, for lack of a better term, we got a lot of estate attorneys out of business. We're going to put them all back in business here in the next, if some of this law goes through, we're going to have estate attorneys coming out of the woodwork.
Yeah.
And it's right. So low.
Hey, Jay, we had another question relative to the capital gains taxes, right? So Dan, so back up on the capital gains tax increase.
Mm-hmm.
The question is from Nate. On a $1.5 million sale, does the 1.5 get taxed at 39%, or is 1 million taxed at 20%, and the additional 500 gets taxed at 39%?
It's number two. In essence, it's the AGI above that million gets taxed, right? So in essence, what we want to do is plan out or limit our tax. We don't want to get into that above the $1 million category if we can at all help it. And I'm guessing, just like everything, like I've said, is, the game is the same. It's just the referee has changed. So how are we going to fix that? We can just plan our way around it. I mean, if we can partially sell something, or if we can do it through some kind of income splitting, we can, or partially like-kind exchange it. We can get around that, especially if it's a bigger property, right? Is maybe we leak that out over time rather than have to push that through. The nuclear option, though, is if they pass all of this together, right? If they get all of this, because then I can't use my like-kind exchange to get around my, right? If it's a $6 million property, I can't go, well, let's sell them. I'm trapped in the $1 million like-kind exchange, $1 million cap gain. I can't manipulate or use like-kind exchange, kind of move it down the road a little bit, then sell it or dribble it out over time. But we still have cost segs, right? We can still do cost segregation to reduce some of those gains, especially if it's based on AGI, right?
Yeah.
We can offset. And so that's a whole other Oprah, and you're going to do a class on those. And that's a good thing.
Yeah, we're going to do a webinar on that next. And then the next one after that's probably going to be estate planning.
Time all together.
We can have a bunch of accountants and attorneys come up there and argue for a while. But I think, to me, this makes cost segs way more relevant, right? If they really graduate these rates this big for cap gains, then cost segs become a bigger it becomes a bigger game. You're going to want to plan that more effectively. Can I offset to get my gain down to $1 million rather than having a bunch of tax? If I can offset with bring some losses to the table with a like kind exchange, especially if the rate doubles. I mean, we're not talking a 2% increase. We're talking almost double.
Yeah.
And you add in the state.
So Dan, how would this affect? I got a backup question to this. So how would this affect your basic fix and flippers that are flipping properties and paying these short-term cap gains every year? I guess it wouldn't, right? Because they're getting taxed at ordinary income anyway.
That's right.
That's not going to really have any impact on them.
So fix and flip's going to be, if you saw my last seminar about fix and flip, what do you that bucketing of fix and flip versus investment properties, it becomes even more pronounced with this, right? It's we want to make sure we're in our investment bucket or our fix and flip bucket or our, rental bucket, whichever way you want to describe it. But, as they start pushing this, if they do, it becomes more important because taxes are getting bigger. The numbers are getting bigger. And I don't think, if I go around a room and I ask, hey, anybody think taxes are going to get cut from here? Nobody raises their hand. So I think the sentiment out there in planet America is taxes are going up. And so and these are the big ones for real estate that I've seen. And some of this we can plan around. I guarantee we'll be able to plan around. But some of it we may not be able to. It depends what they pass, right? Because these will get negotiated out, and the rates will get negotiated. But
right,
we'll see some of it come through, some of it not, or some of it come through in next year. I'm a little nervous about retroactively doing it because it traps people, right? They weren't able to plan it, and especially if they've spent the cash already, right? You go out and buy something, maybe the IRS will take your boat away. I don't know. You say, hey, I bought a boat with it.
I can't see them doing it retroactively.
I can't either, but I'm
honestly, I don't know. But
I think it's a dirty trick to do it retroactively.
Yeah, there's a lot of brain damage for the government.
Well, people have spent the cash too, right? Put it into it's more illiquid. I mean, you go out or you buy another house or you buy another apartment building and you say, well, I didn't know I was going to have to take the other $1 million and pay it in tax. I don't have it. So those are real problems that I think the IRS hadn't really thought about when Congress and Biden came out and said, yeah, we're going to make it retroactive. It's like, well, you get people in some really bad spots doing that because, nobody keeps millions of dollars just hanging around in cash waiting to pay taxes just in case the IRS changes the law. They put it to use. I mean, it gets invested. If you're a real estate guy, that gets into real estate. And that becomes an issue that it sometimes isn't easily fixable. You got illiquid assets or markets changed or rates have changed. You've got to borrow the money. I mean, it's a really unfair thing, I think, to do if they do it. So, but that's, and what's my 2 cents worth at the United States?
Right. Yeah, it doesn't. Yeah. So Jay, we had another question from Barbara.
Yeah, Dan. Barbara asks, if selling $1 million plus property soon, deferred sales trust or go while rates are low? Go as in, I'm sure, hold on. Or
there's no right.
Well, tax rates are low, right? I assume that's what she means.
Right.
Yeah, I mean, the hard thing is will they pass? Will they get it through? Will they get these long-term capital gain increases through? And I don't know, but if it's a property you're definitely going to sell, it's worth looking at. If I say, hey, I'm going to sell it in the next 6 months, in my world, I'd say, hey, is there a way we could accelerate it? And hopefully we don't get a doubling of tax, right? If it means trying to defer it into God only knows when. But the other hard problem too is we don't know if this is going to pass this year, next year, retroactively, or if they get it passed at all, right? That's the big myth in this. And to me, I think it's how do you work with unknowns is use what you know, right? Is I've made a lot of money on a property. I'm okay with selling it. I'm going to sell it in the next 6 months to 8 months anyway. I think I'm at a historic low in taxes. I may miss out or maybe some opportunity costs, the coulda, woulda, shoulda, question of I should have hung on to it another 6 months. I mean, that's the biggest.
Yeah.
Well, the biggest thing you've ever said in your life on dealing with anything, stocks, bonds, real estate. I should have hung on to it. You never. The timing's impossible. It's be happy with the game that you got and say, hey, I got. I was kind of ready to sell it. I was going to sell it in 6 months anyway. The other problem you always have is it's the opportunity cost. If I do sell it, I've got to purchase something else. And
if you're exchanging, if you're not exchanging, I don't see taxes going down throughout all this. So might be better now.
Yeah. I don't, I don't think taxes are going down. I think that's most people's consensus. I think, if you've got an opportunity maybe to reset some basis or pay the gain when it's lower, probably an okay time to do it. Can't tell you for certain, but that's the way.
Also a good time to sell right now since, the market's frothy and people are paying lots.
Yeah.
So, interest rates are low. I mean, all those things come into play, right?
That's right. And I think, Jay, you've been through it, and then Brad is, we're in a really hot real estate market, right? Stuff's really liquid. But if you look at it, if the market goes down, I mean, I was here in 2009 when, I talked to commercial, brokers saying, well, there's really nothing going on. There's no sales. There's no, and that becomes an issue as well, right? Is liquidity. It's I hung on to it. Gosh, I can't sell it, right? I'm stuck with it. But that's the way markets are. They go up and down. They get liquid, illiquid, and they move. And to me, if the market's really, really hot like this and I can sell it and I'm going to sell it anyway at some point, this is not a bad time to do it. And that doesn't mean I'm not going to miss out on some gains, that may be coming. But I also, the downside is there too. It becomes illiquid, rates go up, taxes go up. All those risks are starting to build.
Right.
So I don't know. That's kind of the risks you got to weigh in your mind of what am I going to do. And some people will just want to hang on to it. They'll say, no, I'll just hang on. I'll wait 20 years till the whatever 10 years or whatever it is, or till I die, and then I don't care anyway. So, but yeah, that's really where we're at. But it is, that's what I'm trying to convince people of is really spend some time looking at what you have, and am I going to hang on to it long term, or do I really want to sell it, and what kind of time frame am I looking at selling it, especially if we think taxes are going up in some form or another here, and that's what I think is coming is some kind of tax increase. Does that make sense? Does everybody kind of understand?
Yep.
Jay, you got any other questions, or how are we doing?
Not really at the moment. No other specific questions.
Yeah. And there's other stuff coming down the pipe too, but I think these are the big three that I get a ton of questions on. And I'm guessing Jay and Brad do too, is really the big one is this retroactive increase. Everybody's terrified of that. And I am too. I mean, I just don't think it's fair if they do.
I don't know. I'm not terrified about that. For some reason, I don't see that happening. I would be really surprised.
Yeah, I would be too. But I'm always, you always get shocked by stuff that comes out of Washington, right?
Yeah.
So, I suppose.
But
all right, Dan. Well, unless anybody has any other questions, we probably should just wrap this one up, and then obviously, I think you've got some contact information down here at the bottom of your slides.
Like I've told you guys, I never mind anybody emailing me questions. Somebody says I've got this weird thing going on, or, I might not be able to answer the question of, especially estate taxes. I don't do tons of it, right? If you say, hey, I've got this estate and this plan, and I've got a pour over trust, and I can probably point you in the right direction or get you somebody that can help you.
Yeah, and we can too. Sure, obviously.
I mean, that's what we try to do is give people answers if they're getting nervous or they don't know how to make, build one of those T accounts, help people make a decision if they're going to buy or sell, or, if we can help you one way or another, we'll do it. I think this is a challenging time to own some real estate, because I think it's it's hot. It's done really well, but what do you do now, right? We're getting a bunch of tax increases or potentially big tax increases. Now what, right? And
yeah.
Have to make decisions.
Hey, Dan, flip your slides down to the end so we got everybody has your contact info.
Yeah, there you go. Oops.
Oops. There you go.
Well, there you go. That's me. And then feel free, if you get questions, you know, if it's something, like I said, it's just the same as Brad and Jay. If there's something super complicated, feel free. I'll do my best to answer it, or call me and I'm happy to talk to you about it and see if we can noodle something together and get you the right answers.
Well, I was going to say, likewise, if anybody's considering doing a 1031 exchange, we have a great contact for that. We've done them ourselves. We can help anybody if they have questions on it, if they're not familiar with it. So reach out to us on that. And if you want to roll out into something smaller, such as a duplex to a 5 or a 10 unit, that's exactly what we can help with. So,
yeah.
Awesome, guys. Really appreciate everybody joining us. Hopefully there was some good value there. We will send this recording out to everybody that registered, and we will be posting it up on our YouTube channel as well. So if you need to refer to it again or share it with anybody, feel free. Thanks, guys.
All right.
Thanks very much for coming on.